Well, hello, everyone. Thanks for joining. Grayson Geiler here with SES Services with a weekly market update. We like to talk about things in the financial media, financial press, and go into a little bit of depth. So today I'd like to talk about the pressure release that came to financial markets last week. Okay, so everyone knows that we've had a pretty wild ride in financial markets over the last few weeks, few months, even with some good up to the upside, wild short covering rallies to the upside, and some big downside moves as well, specifically to the bonds and stocks. And last week did not disappoint. After the election, we had a pretty gruesome day to the downside, as certain investors were disappointed for whatever reason. And then inflation numbers came out on Thursday. And of course, inflation is probably the number one topic because the inflation is what is driving the Federal Reserve to make their decisions. And, we haven't seen this sort of inflation in 40 years. So it's really disrupting people's investing habits, spending habits, pretty much across the board investing habits. And of course, how the Federal Reserve is responding to these things. So one of the interesting parts about what happened Thursday after the inflation numbers came out lower than expected, we had an absolutely wild rocket launch in bonds and stocks. Stocks specifically, we had 5, 6, 7% rally in some of the indexes. So it was wild short covering. There were some beaten down stocks that some traders had been short covering that really rocketed, but indexes in general, a huge up day that did spill over into Friday. So one of the interesting parts about it is that the inflation numbers were only mildly lower than what was expected. So the CPI numbers came out at 7.7%, and I think the average guess was 7.9%. Month over month, 7.7 is year over year. Month over month was up 0.4% rather than 0.6%. So, not wildly different numbers to initiate a rocket launch like that. So you have to ask yourself, is the market dead wrong? Well, generally there's some reasons that we may not even be anticipating moving the market. So you just have to tell yourself the market was looking for something, some reason. So lots and lots of short covering again, like I said, but also some people in financial press starting to come out and talk about, well, maybe the low is in, the bear market is over. So some of that FOMO trade, people sitting in cash that, well, if the bear market's over, I have to get my money invested. So I think there's a hodgepodge of different reasons, but a wild rocket launch. And, we've been talking about, we thought the negativity had been overdone for the last few months. We've been talking about that consistently. Now the pressure has been released. Now an absolute amazing rocket launch. Not so sure that we're excited to the upside from here. Now, certainly the low could be in the bear market and we could be off to another bull market, but I'd like to present a couple of different, I'm going to play devil's advocate for a little bit, because when you look back historically, just at the last few market pullbacks, bear markets, the low hasn't been put in before the Federal Reserve stops raising rates. The low gets put in after something breaks from the Fed raising rates and the Fed starts lowering rates. Let me say that again from a different perspective. The last few bear markets, we've had the Federal Reserve raising rates in front of it to avoid inflation. Something goes bad. Think back to 9/11, think back to the 2008 bomb. Something goes bad, the market sells off hard. Only then does the Federal Reserve stop raising rates, start lowering rates. Then after they're lowering rates, the market low gets put in. So that's clearly not where we are now. That doesn't mean this couldn't be different. History doesn't always have to repeat. It rhymes, though. So that's something that we would like to point out. If the Federal Reserve still, look, 7.7 is still wildly above the Federal Reserve's supposed 2% target. So do they by their playbook, should they continue raising rates? Well, I think it's clear that they are going to continue raising rates. Just the idea is that they're going to slow down. So if the Federal Reserve is going to continue raising rates, should we be worried about something breaking? Then the next leg maybe of a bear market sets in, and the low only gets put in after the Federal Reserve starts lowering rates. Well, again, a lot of this is speculation and conjecture. On this impressive rally, if you do feel like you've had too much risk exposure, now's a great time to take some of that off and lighten up, because look, guaranteed interest rates are higher, so there are some no market risk alternatives to the stock market that actually have some firepower to earn some interest. So that's something to keep in mind. But we really want to show you today something that, we've been talking about the Japanese yen as canary in the coal mine, so to speak. The Fed raising rates, the entire world's economy has been loaded up on debt at very low interest rates. So raising rates, of course you fear something's going to break. Somebody's not going to be able to pay their debt payments, finance their debt, make their interest payments on debt if the interest rate continues higher and those interest payments get higher. So, and we've mentioned in previous posts about what has happened in England, some breaking over there, about Credit Suisse needing some help, some bailing out, something kind of breaking there. Nobody knows exactly what. And the Japanese yen. It's a really interesting situation over there, because the Japanese, the Bank of Japan has been chewing through their US dollar reserves. So just for an example, well, just to put numbers on that, beginning of the year, they had about 1.4 trillion in US dollar assets, mostly denominated in our treasuries. They're down to 1.19 trillion as of the end of October. So that's a 15% pullback. That's a couple $100 billion of US dollars that they've been dumping on the market, trying to support their yen. They're trying to support the value of the yen. And we mentioned this a few weeks ago, they really came out in October and tried to catch a bunch of short sellers in the yen, in the currency markets, and get them wailed on, which they did. So when you take a look at our chart of the Japanese yen, and this is just the last few months, but obviously a significant bear market. This was the day that the Japanese central bank came out and really bought a ton of yen, but they had to sell dollars to do it. Remember that. And some short sellers got caught and really hammered on. Well, now, just over the last couple of days, a rocket launch in the value of the yen. Now, correspondingly, on the currency markets, you see some of the other currencies of the world, the euro, the British pound, gaining some good ground against the US dollar. So what does this all mean? Well, when we're looking around the world at situations where they may be more at risk to higher interest rates, they may be more vulnerable. This is the pressure valve, the pressure coming off that market. So when you look at what happened in England, the Bank of England had to sell a bunch of US dollars to bail out their pension fund. Well, you start to worry, what if all these foreign currencies just come completely unraveled versus the US dollar? Well, that sends ripples through the world economy that we have no idea how that turns out. And you look at a chart of the Japanese yen, and I could put one up on the euro as well. Really impressive rally out of danger zone, I guess you would say. So for the near term, the idea that there's complete unraveling around the globe and the economic situation, the currency situation, obviously the pressure has come off. For the near term, that's very good. We don't want the fourth largest economy in the world, the Japanese, to have to sell all their US dollars just to keep their ship afloat. We don't want that. So exactly what happened at the end of the week last week, maybe in a few weeks we'll know exactly what happened. But again, the pressure coming off, which is good news. Now going forward, we have to start to look for other cracks in the dam. Continue to watch the Japanese. Are they going to continue to tear through their US dollar reserves to keep the yen from rolling straight back over? Correspondingly in Europe, what's going on? And then you do look to, and I briefly mentioned this before, the strength of the lot of big rally in the bond market too. So not just strength in stocks, strength in bonds also. Probably give the Federal Reserve more confidence to raise rates again going forward. Just because expectations were 7.9% CPI and it only came in at 7.7, we're not out of the woods yet, is my point. So continually higher interest rates, we might see some other things break worldwide, so we have to continue to be careful. But again, the negativity was overdone. And we're not in a situation for smooth sailing, but we can take a breath, readjust the portfolio if we had too much risk on. So thanks for attending today. If you enjoy the content, please hit like, forward the content to somebody else. We're always here. If you need some help, we'll provide our time as a no obligation, no cost consultation for your specific financial situation. Our contact information is up on the board there. So look forward to hearing from you and hope to see you back next week. Thanks.